Preparing for a FP&A analyst at Tengelmann interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a diversified group like Tengelmann? FP&A connects financial information with operating decisions. At a diversified group like Tengelmann, I would help coordinate budgets and forecasts, analyze performance across business units, explain variances, and provide management with a consistent view of cash flow, profitability, and risks. The role is not simply reporting historical numbers. It involves challenging assumptions, identifying trends, and supporting resource allocation. I would also adapt my analysis to each business while maintaining group-level comparability and discipline. While answering, focus on planning, forecasting, performance analysis, management reporting, business partnering, and translating operating data into decisions across different portfolio companies and business models. Question 2. How would you build an annual budget for a Tengelmann portfolio company? I would start by reviewing historical results, current year run rate performance, strategic priorities, and relevant market assumptions. Then I would build a driver-based budget covering revenue, margins, personnel, operating costs, capital expenditure, working capital, and cash flow. I would challenge assumptions with business owners, reconcile bottom-up submissions to group expectations, and run downside and upside scenarios. Finally, I would document the assumptions, obtain approvals, and establish monthly reporting so the budget remains a useful management tool. Make sure to cover historical analysis, operational drivers, stakeholder input, assumptions, bottom-up and top-down reconciliation, scenario testing, approval controls, and clear documentation of changes. Question 3. What is the difference between a budget, forecast, and long-range plan? A budget is the formally approved financial plan for a defined period and usually provides an accountability baseline. A forecast is an updated estimate of expected results, incorporating actual performance and current assumptions. It should change when evidence changes. A long-range plan looks further ahead and connects financial outcomes with strategic choices such as expansion, investment, or portfolio development. I would use all three together. The budget measures execution, the forecast supports course correction, and the long-range plan guides direction. In your answer, distinguish purpose, timing, flexibility, level of detail, strategic horizon, and how each tool supports accountability, decision-making, and communication with management. Question 4. How would you explain a monthly revenue variance to senior management? I would avoid presenting only a percentage variance. First, I would reconcile actual revenue to budget by volume, price, product or customer mix, timing, foreign exchange, and any perimeter changes. I would confirm the explanation with the relevant business owner and distinguish one-off timing from a structural trend. Then I would quantify the expected full-year impact, update the forecast if necessary, and recommend actions. Management should leave knowing both what happened and whether intervention is required. Be sure to mention separating price, volume, mix, timing, foreign exchange, acquisitions, and data issues, then linking the explanation to forecast impact and recommended actions. Question 5. Which KPIs would you monitor for a retail-oriented business? I would combine financial and operational KPIs. Core measures could include like-for-like sales growth, customer traffic, conversion rate, average basket value, gross margin, markdowns, inventory turnover, stock availability, shrinkage, labor cost per sales unit, and EBITDA margin. I would also monitor working capital and cash conversion because profitable growth can still consume liquidity. The key is understanding relationships. For example, revenue growth with deteriorating margin or inventory productivity may signal promotional pressure or weak assortment decisions. Focus on selecting KPIs tied to commercial drivers, including like-for-like sales, traffic, conversion, basket size, gross margin, inventory, shrinkage, labor productivity, and cash conversion. Question 6. How do you prepare a rolling forecast? A rolling forecast continually extends the planning horizon while replacing completed periods with actual results. I would begin with the latest actuals, refresh key drivers such as sales volumes, pricing, staffing, costs, capital expenditure, and working capital, and obtain input from responsible managers. I would challenge unsupported assumptions and compare the new forecast with the prior version to isolate changes. I would present base, upside, and downside views where uncertainty is material, with clear risks and sensitivities. In your answer, discuss replacing elapsed periods, refreshing operational drivers, involving owners, challenging assumptions, documenting changes, and communicating forecast confidence and risks. Question 7. How would you analyze an unfavorable gross margin variance? I would decompose the margin variance rather than assume it resulted from lower pricing. I would examine selling price realization, purchase cost inflation, product mix, promotions, markdowns, freight, foreign exchange, and inventory provisions. For example, higher sales could still reduce margin if growth is concentrated in lower margin categories. I would compare actual results with both budget and prior year, validate findings with commercial and procurement teams, and assess whether corrective actions or a forecast revision are needed. Make sure to cover price-volume mix analysis, purchasing costs, promotions, markdowns, product mix, inventory provisions, foreign exchange, and whether the issue is temporary or structural. Question 8. How do the three financial statements connect in an FP&A model? The income statement shows profitability, while the balance sheet captures assets, liabilities, and equity at period end. The cash flow statement reconciles profit to cash by adjusting for non-cash items and changes in working capital, investing, and financing. For example, higher sales may increase profit but also receivables, delaying cash collection. In an integrated model, net income flows into retained earnings, CapEx affects fixed assets and cash, and debt movements connect financing to liquidity. I always verify that the balance sheet balances. While answering, explain income statement profitability, balance sheet movements, cash flow reconciliation, retained earnings, working capital, CapEx, debt, and the importance of model integrity. Question 9. How would you forecast cash flow for a Tengelmann business unit? I would start with operating profit or EBITDA and convert it to cash by modeling taxes, interest, provisions, and working capital movements. Receivables, inventory, and payables would be forecast using operational assumptions such as days, turnover, purchase timing, and seasonality. I would separately model capital expenditure, disposals, debt movements, and other financing items. I would produce both a monthly short-term cash view and a longer-term forecast, then highlight minimum liquidity, funding requirements, and the assumptions most likely to change. Discuss operating cash drivers, EBITDA, working capital, taxes, CapEx, financing, seasonality, liquidity buffers, cash timing, and coordination with treasury or finance stakeholders. Question 10. What is working capital, and how would you improve it? Operating working capital generally includes receivables, inventory, and payables, and it affects how much cash the business must fund before collecting customer proceeds. I would assess days sales outstanding, inventory days, days payable outstanding, aging, slow-moving stock, and purchasing terms. Improvement might involve better demand planning, faster billing, tighter collections, inventory rationalization, or supplier term negotiation. I would avoid optimizing one metric in isolation, because excessive inventory reduction could harm availability and revenue. The goal is sustainable cash conversion. Be sure to define operating working capital and address receivables, inventory, payables, cash conversion cycle, commercial trade-offs, ownership, and measurable improvement initiatives. Question 11. Tell me about a time you found an error in a financial report. In a previous reporting exercise, I noticed that an expense trend was inconsistent with both headcount and prior month activity. I traced the variance to a duplicated data import and confirmed the issue against the general ledger. I informed my manager, quantified the reporting impact, corrected the file, and communicated the change before distribution. Afterwards, I added a duplicate check control and a variance threshold review. The experience reinforced that analytical review is as important as mechanical reconciliation. In your answer, use a concise star structure, explain the control or analytical clue, quantify the impact, describe escalation and correction, and show the preventive control implemented afterward. Question 12. How would you ensure data quality when consolidating information from several portfolio companies? I would establish standardized templates, KPI definitions, chart of accounts mappings, submission calendars, and clear ownership. Before consolidation, I would run checks for missing values, unusual movements, inconsistent signs, duplicate records, intercompany mismatches, and balance sheet integrity. I would reconcile submissions to source reports and retain an audit trail for adjustments. Where businesses use different systems, I would document mapping logic rather than forcing unexplained uniformity. Exceptions should be discussed with owners and escalated promptly when they affect management conclusions. Focus on standardized templates, definitions, mapping, validation checks, reconciliations, version control, deadlines, ownership, audit trails, and escalation of inconsistent submissions. Question 13. What makes a strong management report? A strong management report is accurate, concise, consistent, and decision-oriented. I would show actual versus budget, forecast, and prior year, supported by relevant operational KPIs and a clear bridge explaining material movements. Commentary should state the cause, whether it is temporary or recurring, the expected impact, and the proposed action. I would tailor detail to the audience. Executives need key messages and risks, while business owners may need supporting analysis. A report should make decisions easier, not merely display numbers. Make sure to mention accuracy, relevance, concise commentary, visual clarity, trend analysis, decision-focused insights, consistency, audience needs, and separating facts from assumptions. Question 14. How would you evaluate a proposed capital expenditure project? I would assess strategic rationale first, then model the investment, incremental revenue, costs, working capital, taxes, depreciation, terminal value, and timing of cash flows. I would calculate payback, NPV, and IRR, while testing downside cases for delays, lower volumes, cost overruns, or weaker margins. I would also consider capacity, regulatory, operational, and execution risks. After approval, I would compare actual benefits with the business case so capital allocation decisions improve through disciplined post-investment reviews. Discuss strategic fit, upfront investment, operating benefits, depreciation, working capital, cash flows, payback, NPV, IRR, sensitivities, execution risks, and post-investment review. Question 15. How do you use scenario and sensitivity analysis in FP&A? Sensitivity analysis changes one assumption at a time, such as sales growth, margin, wage inflation, or interest rates, to show exposure. Scenario analysis changes several connected assumptions to represent coherent outcomes, such as a base case, downside case, and recovery case. I would focus on drivers that materially affect EBITDA, liquidity, covenants, or investment decisions. The purpose is not to predict perfectly, it is to show management where the business is vulnerable and which actions preserve flexibility. In your answer, distinguish scenarios from sensitivities, identify key value drivers, quantify impacts on profit and cash, avoid false precision, and explain how management uses the results. Question 16. How would you handle a business manager who challenges your forecast assumptions? I would first understand the manager's operational knowledge and the assumptions behind the challenge. Then I would compare those assumptions with actual trends, external evidence, capacity constraints, and historical forecast accuracy. Rather than arguing over a single number, I would model alternative cases and show the effect on earnings and cash. If disagreement remained, I would document both views, agree on a base case with transparent risks, and involve the appropriate decision maker. Constructive challenge should strengthen ownership, not damage relationships. Be sure to cover active listening, evidence-based challenge, shared definitions, driver-level discussion, alternative cases, transparency, relationship management, and escalation only when necessary. Question 17. What Excel skills are important for an FP&A analyst? I rely on Excel for data preparation, analysis, forecasting, and communication. Important skills include SUMIFs, XLOOKUP or index match, pivot tables, logical formulas, date functions, charts, scenario analysis, and error checks. For recurring work, Power Query can improve efficiency and reduce manual manipulation. I structure models with clear inputs, calculations, outputs, and documentation, avoiding hard-coded numbers where possible. I also test formulas using reasonableness checks, because a technically sophisticated model is useless if its outputs cannot be trusted. Mention pivot tables, XLOOKUP or index match, SUMIFs, conditional logic, charts, scenario tools, data validation, Power Query, model structure, error checks, and clear documentation. Question 18. How would you improve a slow or manual monthly reporting process? I would map the process from source data to final report and identify repetitive manual steps, rework, bottlenecks, and control gaps. I would standardize definitions and templates first, then automate suitable activities through Power Query, structured Excel models, or reporting tools. I would preserve review controls, reconcile automated outputs to the existing process, and pilot the change with users. Success should be measured through shorter close times, fewer errors, and more analyst capacity for interpretation rather than data collection. Focus on mapping the current process, identifying repetitive tasks, standardizing inputs, automating data preparation, validating outputs, preserving controls, measuring time saved, and managing stakeholder adoption. Question 19. How would you assess the performance of a newly acquired business? I would establish a clean baseline by aligning accounting policies, reporting periods, organizational perimeter, and KPI definitions. Then I would compare actual performance with the acquisition case and budget, separating standalone performance from integration effects, one-time costs, synergies, financing, and purchase accounting impacts. I would monitor revenue, margin, cash conversion, working capital, CapEx, and operational milestones. Regular reviews with management would identify underperformance early and determine whether assumptions, resources, or integration plans need adjustment. Discuss establishing a baseline, perimeter and accounting alignment, synergy tracking, budget versus actuals, cash generation, integration costs, operational KPIs, risks, and realistic reporting cadence. Question 20. Why do you want to join Tengelmann as an FP&A analyst? I am attracted to Tengelmann because its diversified structure would expose me to different operating models, investment perspectives, and performance drivers. That environment is particularly appealing for FP&A because analysis must be both rigorous and commercially practical. I would bring strong Excel and financial analysis skills, curiosity, and a willingness to challenge assumptions constructively. I also value roles where reporting leads to action, whether improving profitability, managing cash, or evaluating investment priorities. I see Tengelmann as a place to develop broad finance judgment. In your answer, connect Tengelmann's diversified investment and operating environment with analytical development, business partnering, ownership, adaptability, and your specific motivation for contributing to performance management. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.